Hey, this is Trader Travis, and what I want to do in this video is talk about the Family Freedom Fund strategy. It's my favorite strategy to use. It's a strategy that combines growth with income, and believe it or not, it actually benefits from market crashes. Now, this is just going to be a big picture overview because it's important for me to cover the psychology that you need to use this strategy, because if you don't get that right, you won't succeed. In my personal example, I started out as a real estate investor. So I learned from a millionaire. I had the tools of the wealthy, but I had the mindset of an impatient poor person. So while I made a lot of money initially, I eventually lost it all and went bankrupt. While others in my class using the exact same tools and strategies they went on to become multimillionaires. So it was an incredibly humbling experience. And it taught me that you can't just have the tools. You also need the psychology. But before I cover that strategy, let me do a quick recap of what I talked about in my Option Profit Formula report. And in that report, I talked about, the 3 pillars of financial freedom, how to invest like a billionaire. And that Forbes magazine releases a list every single year of the world's richest individuals. And they all make their money primarily one of 3 ways: through a business they own, their stock market portfolio, or through rental properties they own. So the millionaire I learned from said, if you want financial freedom, it's best to focus on one of these areas. Get really good at it. And another thing I learned is that a lot of wealthy investors are obsessive about not losing money. You think they're huge risk takers, but before they make an investment, they always want to protect themselves from the downside. So what I started doing is picking up tips from people like Warren Buffett and use what he was teaching other people to create what I call the Family Freedom Fund strategy. So during market crashes, stocks will fall anywhere from 20 to 40%. So this strategy is where I sell stock insurance to other people. I'm insuring their portfolios, and I'm also agreeing to buy their stocks at really deep discounts in the same way that, your insurance company will insure your home and you will pay them premiums every single month. So that's somewhat what I do in the stock market. Essentially, I get paid to wait. It's a way for me to get paid to buy stocks I want to own at the prices I want to own them at. Now, the challenge here is that most people will look at this performance. I'm comparing the performance to the S&P 500 from the date I started this particular model account, and it's trailing the S&P 500 by about almost roughly 6%. If we round these up 10 and 4%, you would say my performance is trailing the S&P's performance by about 6%. And the reason I compare it to the S&P is because this is what mutual fund managers do. They usually compare their performance to a benchmark, and one of the major benchmarks is the S&P 500. So people will look at this and say, "Oh, you're a horrible investor, Travis. This strategy sucks." But that's where people need to think like a billionaire or think like a rich person. Here's the way my mentor explained it. He said, poor people think in days and rich people think in years. And you can substitute poor people with people who are unsuccessfully financially, if that helps you swallow his advice a little better. But the point he was trying to make is that poor people generally, overall blanket statement, they generally want results immediately. And if they don't get results quickly, they go off in search of the next bright, shiny object. They never stick with anything long enough to get results. Now, I call this dabbling, and dabblers die broke because their dreams are stolen by distraction. But people who are wealth-minded, people who think like a billionaire, they will evaluate the Family Freedom Fund strategy and look at it in terms of risk and its long-term potential. So yes, it's up only about 4% thus far. That is not impressive. Don't get me wrong, I am not saying that's impressive, but what will this strategy earn over 10 years? That's how a billionaire would think. So let's look at some of the benefits of the strategy. You get paid roughly 3% a year to wait to buy stocks. You're going to avoid the 50% drops. You're only going to buy during market crashes, which is going to give you a higher yearly return on investment versus the buy and hold 9%. And then the bonus benefit is that once you own the stock, you can actually rent out your stock shares for extra cash flow each month. That's the oldest and most widely used option trading strategy, which a lot of people don't know about. And by doing that, it increases your yearly return on investment. So for example, let's pull up a chart of the SPY. This is the ETF of the S&P 500. Now, hypothetically speaking, if you had bought SPY here on or around the bottom of March 2009, the bottom of this particular market crash, and you roll that all the way up to 2017, that you would have a yearly average return on investment of about 30%, give or take. And in my opinion, that's much better than the buy and hold 7 to 9% that a lot of people quote. And the reason the percentages are so different, if you think about it, is because buy and hold, you suffer all these major losses. But with this particular strategy, you don't, or at least it's designed so that you don't. But of course, you always have to factor in human behavior, because sometimes we can screw things up. And I know that from personal experiences. So if we start here at 30%, and then we add in the conservative 3% a year we will receive on the front end by selling stock insurance to other people. And then we add in another conservative 6% a year we receive by renting out our stock shares. That brings the yearly average to about 39% a year. And this is, of course, best case scenario. So let's look at some number examples here so you can see how this plays out in real life. So if you had a $500,000 investment account or retirement account, you earn 39% a year, that will be $195,000 in passive income you would receive. Now, passive meaning you don't physically work for the money. So can you now see why this is my absolute favorite strategy and why I call it the Family Freedom Fund? But let's go ahead and move on, because what I want to do is take this example down a bit to what most retirees have, and that's $200,000. So $200,000 earning 39% a year, it's still 78 grand in passive income. And if you only earn 15%, that's 30% a year. And that's what I target. I target the 15% because in my opinion, it's more realistic and more achievable. And so let me ask you, would you gladly accept an extra $30,000 a year in passive income? And I know the answer is yes. And I also know that, yes, I know this is all theory to you. It means absolutely nothing. This example is no different than all the other examples you see online. And as any of my students will tell you, I hate theory. I hate theoretical examples. So I'm putting my money where my mouth is. And over the coming weeks, I'm going to let you peek over my shoulder and watch me invest my own account. And so I will release those videos as they become available. But before I let you go, I want to do a quick summary here of this Family Freedom Fund strategy. It protects you from the downside, and it also forces you to think like a wealthy person. It forces you to think long term. It forces you to have one of the necessary ingredients for success, and that's patience. Now, how it protects you from the downside is because you're only going to buy during market crashes. So for me, roughly about 100% of my money will sit in cash until the crash happens, but I still earn money each year. It's not like sitting in a savings account earning like 0.01% interest. I'm still earning interest. I'm still getting a decent return on investment because other investors are paying me to wait in exchange for insuring their portfolio. Now, this brings up some objections from the experts because the experts will say, well, Travis, you're timing the market, to which I would say, yeah, I reject your brainwashing phrase that you use to train people to keep their money invested all the time. Because if you keep your money invested all the time in a 401k or things like that, they can continue stealing your wealth every year in fees. Now, this has nothing to do with timing the market. It's just smart investing. Think real estate investing. Sometimes you have to think like a real estate investor to do well in the stock market. Do real estate investors make money by buying expensive homes and hoping they go up in value? Or do they make their money by buying cheap foreclosures? It's called buy low, sell high. You know, that thing that everyone keeps saying you should do to get rich. But think about it. How can you ever sell high if when you try to sell high, they say don't time the market? And if you time the market, you'll lower your performance. So which one is it? Buy low, sell high, or don't time the market? Do you see how contradictory that is? It's a mixed message, which is why a lot of people are confused and a lot of people lose money over them all. Now, I will state publicly that, yes, I don't believe in predicting or timing the market, but I do believe in smart investing, and buying low, selling high is smart investing in my humble opinion. Because the only way I have found to get rich is by buying assets when they are on sale. So although this account doesn't make much money now, it's still profit. And then when, not if, but when the market falls, I will buy my stocks at deep discounts. Then once I buy the stock, I will have a lower cost basis than everyone else, which means I'll make more money than everyone else when the stock goes up. And then I can make even more money by renting out my stock shares for extra cash flow each month. But despite all those benefits, the one downfall is I don't earn much money on the front end. But that's also, in my opinion, the beauty of this approach, because it's a secret 10-minute wealth building strategy I use. I literally manage my investment account like 10 to 15 minutes a year. It's simple, it's boring. It doesn't scream, oh, double your account every year. And that's why people don't pay attention to it. And by the time they see the profit potential, it's too late. They've missed out. They have to wait another 10 years to benefit because they have to wait for another market crash. And this is exactly why I tell my students, the biggest opportunity to build wealth is during market crashes. You make your money when you buy, not when you sell. And the best time to buy is during market crashes. So always be prepared for them. They come in cycles. These cycles have been around since the 1900s. So if you have your money invested in the stock market, you absolutely 100% should have a way to profit from market crashes. And if you don't, then you absolutely need the Family Freedom Fund strategy. You take care, and I will see you in the next update. Bye-bye.